All right, everybody. As I always like to say, give me a second. I'm going to make sure that we are streaming across various platforms. Should be a good conversation here. We're doing a two-guest type of dynamic for today's episode of Lead Lag Live, which is sponsored by Trader ETFs, one of my clients. As we are live, please, folks, do me a favor. If you want to engage during this roughly 15-minute conversation, it doesn't matter if you're watching on X, LinkedIn, YouTube. I can see your comments. Let's make this interactive, which means if you want to ask any of us questions, post on whatever platform you're on. I'll bring it up. We'll make it interesting from that perspective. This will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. And for those that are curious to learn more about Trader ETFs and their suite of levered funds, which are different in terms of the way they're constructed and how they perform than typical leverage funds, we'll talk about that towards the end here. So with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Now, join me for roughly 50 minutes are two great guests, Matt Markiewicz and Paul Schatz. I had Matt on a podcast, I think it was about a month or so ago. But Matt, for those who are not familiar with your background, introduce yourself. Who are you? What have you done throughout your career? And talk a little bit about Trader ETFs.
Hey, thanks for having me on, Mike. Matt Markiewicz. I am head of product and capital markets at Trader ETFs, which runs a suite of 16 exchange traded funds. We are, all traded on the NASDAQ right now. From a personal background, I have been on Wall Street 27 years, various sales, trading, research roles, and have been in ETFs for 15 years, having cut my teeth at iShares, which is the largest ETF issuer in the world, of course, and now doing something a little bit more entrepreneurial, and really pleased to be here.
And of course, Mr. Paul Schatz, who I didn't realize I actually had met many, many years ago. But Paul, go ahead.
Good morning. Thanks for having me. Paul Schatz. I am president of Heritage Capital, a registered investment advisory firm in Woodbridge, Connecticut. We're a stone's throw from New Haven. So I've had my firm since I launched my firm in 2003. Wow, so that's 21 years, 21 and a half years now. And before that, I worked for a large regional firm. Before that, I worked on Wall Street for Shearson, the old Shearson, Lehman, and then Cowan and Company. I was a survivor in those days. I came in after the crash of '87 when there weren't many jobs, and my groups just kept shrinking, and I somehow figured out how to survive each rounds of cuts at the various firms I was at. So at the end, I decided I did not want to live in Manhattan. I did not want to work in Wall Street anymore. I wanted kind of a better quality of life, which included a lot of golf and skiing. So I moved back to Connecticut, where I grew up, and have been living happily ever after since.
That word survive is a good one to focus on for a bit, because there are a lot of vehicles out there from an investment perspective that are really good at helping people thrive. And there are a lot of vehicles that are not really designed for that. They're more designed for playing defense and survival mode when those cycles inevitably hit. As an advisor, Paul, I want you to talk about what do you do with your client capital as a fiduciary when you're in survival mode for them in terms of asset allocation?
So I've been doing this 35 years. I can't say I've seen it all, but I have seen an awful lot. I know people say, well, how come you still have your hair? Well, I didn't have all this gray stuff on the side before I got in the business and before I had 3 children.
There's also wigs, in fairness.
There's also what?
There's also wigs. I mean, I don't know if you're wearing a wig.
That's true. No, listen, my friends will share, God didn't give me much, but I did get a really good head of hair. I didn't get a lot of height, maybe not a lot of looks, but hair I got. So regarding the answer to your question, it took a while to realize this, but one of my principles in managing money is if you weren't smart enough at the beginning of a decline, because typically declines go a lot faster than rallies do. Whatever analogy you want to use, the escalator to the top and the elevator to the bottom, so declines happen much faster. And I've often said to people, did we lose Michael?
I think we did, but we're still on.
Oh, okay. So
it's the Paul and Matt show. Hello, everybody. Happy Friday.
There he is.
There he is.
So
You're good.
I've often thought that if you were not smart enough, a little like the COVID crash, as the market's accelerating, or if you weren't smart enough to take action before that, not that you knew some kind of action was coming, but that your models or something told you it's time to bring in risk, cut longs, increase shorts, raise hedges. But if you weren't smart enough to do it before the decline, to begin the decline, I always felt that it's a losing strategy to chase declines lower and lower, because when things mean revert or they turn, you're going to get left with nothing. So survival mode for us is over the years, especially like 08, is we've become decent at selling rallies and downtrends. It's not rocket science. The first, we can talk about this as we go, but the first decline off of an all-time high, most people think it's your normal pullback, except it never goes back to all-time highs. It makes a series of lower highs, and that's where I think advisors and people with more quantitative or non-emotional models can add value, participate, and help their clients.
So, correct if I'm wrong, but if you're going to focus on survival, you have to be, by definition, tactical to some extent, right? Because, you don't want to chase it while it's happening necessarily, but if you want to be defensive in advance, you gotta even be active as far as that goes. What are some of the things that typically make you get concerned about the environment around you, that make you want to position more defensively before the whites of the eyes of something regime change may be coming?
So there's a couple of things along the way, and I know. So there's something called I call it the gap of recognition. During a decline, there is, not always, but there's usually that big lower opening where, make up a number. It's 1%, it's 2%, whatever it is. But it's that gap lower where everybody realizes, you know what? This is not your typical low single digit pullback from an all-time high. This is an something has changed. A lot of times that gap of recognition freezes people, like the deer in the headlights. So when that gap of recognition comes, we typically will sell the first bounce off that. That's number one. But long before the gap of recognition, I think as markets build to a peak, and I think you have to define what kind of peak you're worried about. So the average person who's buying index funds or setting a 60-40 allocation is not going to worry about it. They're going to roll through the 10, 20, 40, and 58% declines like we saw in 07, 09. But things that I look at are narrowing participation. This is not rocket science. When fewer and fewer stocks participate, it's a warning sign. It's not a sell everything sign. You look at, kind of the confluence of data. So that's one thing you look at. That less and less stocks are participating. Other things you look at are leadership. We all like to see, well, many of us like to see, semiconductors leading, which is a subset of technology. That's healthy. We like to see banks and financials leading. We like to see consumer discretionary leading, and we like to see transports leading. Different parts of the economy, different parts of the market. Most advances will die when leadership dies. Now, before COVID happened, I'll say this: the financials traded great into early 2020. So if you were just looking at one single thing and not a weight of evidence, you're like, oh, well, financials are okay, market must be okay. I like to look at, so another thing, we'll look at credit spreads. When high yield spreads begin to start widening like the alligator's mouth, again, it's not a sell everything, but it's another weight of evidence that, look, risk is increasing. And as active managers, that's what we're doing. I think it's a fool's errand for me to come on and say, look, we're going down 40%. It's August of 87. We're going to have this great stock market crash. That's a generational thing. As active managers, when risk increases, we want to do something proactive. It doesn't mean we're always going to be right, but you want to either hedge, you want to raise some cash, you want to rotate out of some higher risk or higher beta areas into some lower ones. We do something to help a client's portfolio, or we seek to do something to help a client's portfolio.
So you and I both know you can never pick the top and you can never pick the bottom. So let's say you have a correction and you're starting to get more bullish, but you don't know exactly where the bottom is. Maybe you'll get lucky. Maybe you're bullish the day that the market bottoms, or maybe you're doing it 2 weeks or 2 months in advance of a major shift, major bottom. We all know that the biggest returns come at the turn of the trend, not in the middle. And sometimes the best thing to do when markets are going down is to double down, right, and go long. Obviously, there are a lot of practitioners that use leverage funds to do that. I want to hear your take on using levered products in general as a fiduciary, as an advisor, because some advisors use them, others are nervous about fiduciary risk responsibility for some of their clients. These are clearly high risk type of products in general, but talk about your usage of leverage products and how do you think about them when you're towards the tail end of a corrective environment?
So there's two. I'll unpack it two different ways. So first, I've been all over the levered product spectrum, and since they came out, I think Pro Funds launched, if I'm not mistaken, in '97, because they launched at an industry conference, NAME, where I met you, Michael, National Association of Active Investment Managers.
And those are mutual funds, as I recall.
They did, correct. They launched at one of our meetings, and then RightX, either was right before or right after. I don't think it doesn't matter, but early on, so I adopted them early on into our models without fully understanding them. Problem number one, that was fully on me. It was a learning experience. The early levered products were daily resets, which just means every single day you own the product company reset the leverage, whatever the leverage was, 1.5, 2 times, and then they obviously went up from there. So after I invested them and lost and couldn't figure out why the index was up and my portfolios were down, I learned in first half of 2000 about the compounding effect of owning levered products, which is really, if you're a spreadsheet junkie, you can put it in a spreadsheet, do it on your own. But the bottom line is the longer you own levered products that reset every day, the worse your performance will deviate from the index. And so I learned that. It was certainly a comeuppance, and then I pretty much avoided levered products from the middle of 2000 for many, many years. And then other products came out. I met some really smart people who explained to me and taught me some more shorter term ways to use levered products. And now, so I think levered products have places in portfolios for active managers, number one. And the key is, buyer beware. If you're looking to own a levered product for weeks or months or quarters, and you own a daily reset product, you're going to be probably disappointed, unhappily surprised, because your portfolio will not go pari passu with whatever index you're looking to track, the Dow, the S&P, the mids, the smalls, the NASDAQ 100. So I think depending on the strategy you're employing, so for us, I'd have a hard time just buying and holding a levered product forever, putting it in if I had a 60-40 blend and buying and holding it, which we don't, I'd have a tough time with that. For anyone who's active, I think they can be a wonderful addition. They can help you when you have high conviction on a trade or a thesis. I think they can really help you. And look, when you own a levered product and you're right, the gains are magnified. And when you own a levered product and you're wrong, the losses are magnified. Common sense. But like anything else, you have to have a plan for when you're wrong. And I've 35 years in the business. The number one thing I tell people is when they discuss ideas with me, great. What happens when you're wrong? So you always have to have a plan for when things go awry. You can't just sit and back and hope, because hope is not an investment strategy.
I want to go to you, Matt, on this, because this point about the compounding effect, I think, is often misunderstood, especially by retail, which tends to love these types of products. Do you find that it's just kind of a hard concept to explain the idea that it's less about direction and more about that path behavior? Because that rebalancing point is where the deviation really gets to be significant.
Yeah, I think verbally, Mike, it is a tougher concept to understand. And as Paul said, get the spreadsheet out, kind of come up with some scenarios and, in terms of how that underlying asset might move each day. And that path dependency really is going to dictate your experience with holding 99% of the levered products. And when I say 99%, as I think we talked about last time, there are 200 plus leveraged ETFs out there. And all of them, except for our 12 funds that we just launched, they reset the performance daily, as Paul alluded to. So, people have this understanding of how leverage works. But again, that daily compounding, the longer you hold it, the expectation that you have to meet that actual leverage, it will deviate at some point, depending on how that market is trending. In an uptrending market, a strongly uptrending market, the dailies will outperform our products that are called calendar resets that reset at a weekly, monthly, or quarterly basis, right? In a choppy market, you should expect the longer reset, the longer you hold it, to slightly outperform, especially on a risk-adjusted basis. And in a downtrending market, because if you think about it, our products are systematically resetting, right? At a week, a month, a quarter. So if you're holding it through a downtrending market, essentially we're buying weakness, right? And on the way up, we're selling strength, which kind of, in a couple of Paul's strategies, which happen to be trend following, are counter, right, Paul? Like you'd want to, if you think the trend is going to last for 2 months, maybe, and strongly, you'd probably want a longer reset period product, like our quarterlies, right? For instance, you wouldn't want the weekly because you keep resetting that leverage every single week. So you're selling that strength. And that's something where, Paul said sort of the magic words, like, depending on your strategy, knowing what your outlook is, right? That's where you really want to kind of match the duration of your leverage with the product.
So I think also to interject, Michael. So, Matt laid it out fairly well. And if you're a spreadsheet junkie and you just put a sequence of returns, daily returns in, like, -1%, +2%, +3%, -3%, in a choppier environment, as you reset the leverage every day, it basically skims off the top of your returns versus when your leverage gets reset, weekly, monthly, quarterly. And I totally agree. Yes. And to Michael's earlier question, markets are in free fall. We know they don't go down forever, but your models get more and more bullish. That's when you begin to nibble on a monthly or a quarterly reset. Even if you start with weekly, and then you can always pivot until longer resets. It's not a one size fits all. There's plenty of ways to do this and to do it smartly.
As an advisor, when you're doing these types of products or using some of the trader ETFs funds, are you focusing on a particular broad-based S&P one that's on the Qs, one that's on treasuries? Talk about sort of your opportunities that you're playing with.
It really depends on the model. So I've not traded too much in levered treasuries. We have a treasury piece that's part of a global macro model, but that's not where we add really good value. On the equity side, we have certainly, we look at the S&P 500, the NASDAQ 100, and the Russell. Those are our three big indices that we follow. So, and look, until recently, the Russell's been just insanely difficult to trade from the long side, unless you were only doing mean reversion, selling every rally, buying every decline, which worked great for several years. Obviously, now the Russell's in a different regime. And that's what I tell, other advisors ask about, well, how do you do this? I always say, I'm not the smartest guy in the world, and I'm always open to learning. I think in our business, we learn. If you don't learn something every day, you're missing out on opportunity. But if you put the markets into regimes, I think it really helps you to figure out what products to buy and what your time horizon is going to be. The Russell for the last couple of years has been in a very choppy regime. So you could keep things on the shorter side. Now that it's broken out, the regime has clearly changed. So your product use should change.
And it has been, right? Small cap's been compared to SPYs and Qs anyway, since the election, been the best performing, slice of the equity market, over the past 8 days or so. So are you seeing that?
Although I will say that seems to be reversing for whatever it's worth, just the last.
Yeah. There's some weakness today. Yeah. But I mean, Paul, is that something, in your strategy when you're looking at these types of regime switches, does the global macro picture come into play? I mean, do you think election, administration change, maybe more favorable for equities, or you're just strictly looking at the charts and the trends?
So more of the latter. I would say this. If you tell me about geopolitical events ahead of time, you say to me, look, I know what the outcome is. You figure out how to invest it. I think it's equally as difficult because a lot of times the outcome doesn't match the outcome of the geopolitical event doesn't match market reaction depending on how the market's traded going into the event. So I always have a thesis, right? Could be whatever the thesis may be, but we typically follow our models. Does it matter whether Trump won, Harris won, shared power in how I look at the market? It does not. It makes it easier to create. If you want to create a narrative to support your position, becomes much easier after a geopolitical event. But look, we look at things like simple things like, comparing the Dow to the S&P, the S&P to the Russell to the NASDAQ 100, and then we rank order the major indices we trade. And if we had shared power or Harris won or Trump won, doesn't really matter. That the market does a pretty good job of telling you in advance about what some kind of geopolitical outcome is going to be.
I want to go back to the whole idea of being defensive because as an advisor, a fiduciary, you might be incredibly bearish, but you have an investment policy statement. You still need to have some exposure to equities. What about doing strategies where you're using leverage products like what Trader ETFs has, and you're cutting that? So instead of having 50% SPY, right, you have 25%, and you're using a calendar reset, S&P levered fund, and that way you have just more cash, or you can even allocate into other defensive assets. I mean, it seems to me that everyone likes to think about the levered funds from an up capture perspective, but you can use them to still maintain somewhat of the same exposure, and now you're freeing up some cash. That's what you have.
So I agree with you. Everyone does look at things from a pedal to the metal max on exposure. And I guess, and if you have a plan and a process and a model and that works, great. Keep on. But I agree with you. So what we'll do is, let's say, so we've been trading SPY B, which is one of the products. And so I think it was, in the last couple of weeks, where we cut our S&P exposure. So we took part of that SPY B position, and I think we bought the ag. I was about to say the Lehman ag, but obviously Lehman's no more. And how old I am. So we took some of that position. We kept some kind of core on in levered S&P, and we took the balance and we bought the bond index. And that's how we'll think about it. We may take our MQQQ position, which is a new one that we started trading lately, and we may cut it down from make up a number 20% to 10%, and put the other 10% in a lower volatility equity ETF or a dividend paying ETF, something along those lines. But yeah, it is, Michael. When I came in the business, I was taught to be very black and white. If you like the market, you're in and you're all in. And if you don't, you're all out. 35 years has taught me, one, markets have this permanent tailwind. So being a perma bear, it's hard to run and grow a business and to seek to grow client wealth. It's a tough spot to be in. So with that permanent tailwind, do you have to have a position long? Always? No, but for the most part, we'll have some skin in the game, and then you can always hedge it back with either inverse ETFs or cash or a security that is inversely correlated, goes down when the market goes up when the market goes down. So yeah, I think again, plenty of ways you can play it, and you can the leverage can help you add all kinds of securities to the portfolio while maintaining some kind of core equity position.
Matt, I mean, a good plug for Paul, but he's kind of like the ideal type of advisor relationship for you guys. Because one thing that we haven't addressed, Paul mentions SPYB. There's not much AUM there, not yet. Volume's not super high, not yet. But you and I both know that volume and AUM doesn't matter when it comes to ETFs.
Yep.
It's hard to find advisors who get that.
Well, I think that sort of goes to what Paul just talked about, which was, he has years in the business and he understands that nothing's black and white. So just because an ETF doesn't have a lot of volume, Paul knows that the security that is behind SPYB is the largest and most actively traded security on the planet, SPY, right? So that's really when Paul's looking, whether it be any of our suite or others, he's just looking at the best vehicle to use to match his view, right? So part of our outreach, in our marketing campaign, especially to fiduciaries, is to first look at advisors who are actively using ETFs that might not just be SPY, right, or triple Qs. The flagship GLDs and all that, look at advisors who are thinking outside the box, because they understand that they just want the best vehicle to get the job done, to express their view, right? Whether it's leverage ETFs or not, which is why we've really connected with a lot of the advisors in that name group that Paul mentioned. I mean, it's been a fantastic association. We've really gotten to know a bunch of the advisors there, and it's interesting because they're actively trading securities. It's not just, Paul mentioned, we don't 60-40. That's kind of not our bag, right, Paul? That's not really the model that you follow. We want to speak to fiduciaries who are of like mindset, like us, who are creating out of the box products. And, the name organization is full of them. So we've had great traction, great conversations with a lot of the advisors and RIAs in name. And, a lot of them do understand that just because an ETF is $8 million in assets and just launched, that doesn't mean it's not something worth looking into. And, they understand that there's a hidden liquidity in ETFs, Mike, right? Something that you and I have talked about before. And at the end of the day, this is our strategy is, as I said, it's systematic in nature, right? For SPYB, every Friday at the close, we go back to 2x the leverage. It doesn't matter whether at the time we're over 2 or under 2. Every Friday at the close, back to 2x. Then the next Friday, same type of thing. So follows the same pattern. So as long as you understand the product structure and the ETF product structure, I think you'll get much more comfortable in using more esoteric products to express your investment views, and not just the plain vanilla products that are offered by all the big ETF issuers out there.
Can we talk about, Matt, how that leverage is achieved and how just mechanically that rebalance takes place on the fund level? Because somebody could say, listen, I can just do this myself if I'm actively watching positions, right? But talk about just what's kind of behind under the hood there.
Yeah, well, relative to the comment you just made, you could do it yourself 100%. But however, margin and using leverage at a lot of brokerage platforms can be expensive. I don't do it myself. I don't know what that number is right now, but I bet it's upward of 6 to 8%. We'll love some of the audience to chime in if they are doing it themselves, to kind of let us know what that cost would be. Secondly, Mike, it's exhausting, right? To be constantly relevering your portfolio so that you're not getting those allocations out of whack. And especially for someone like Paul, who just wants to remain long and strong, the S&P 500, for instance, he doesn't want to sit there and, my leverage got all messed up because of this move these past couple of days. So I got to go and, across my 150 client accounts, I have to go and change, the leverage for each one of them, and to stay kind of within bounds. And so a lot of it, Mike, is, it's ease of use, right? You don't have to worry about going out and, using leverage from your brokerage platform. If that's like your main job and that's all you're doing all day, that's fine. But most investors, they don't want to have to deal with the hassle of, reallocating their positions day in and day out. In terms of how we get that exposure, we use something in all 16 of the trader funds called a total return swap. And those swaps are contracts with counterparties. Most of them all of them banks and broker dealers. It's a contractual agreement by where that bank or broker dealer guarantees performance relative to whatever that leverage is over that certain time period. So let's take SPY B, for instance. Counterparty will say, we guarantee you 200% of the weekly return of SPY, and that's reflected in the account and kind of the in the swap agreement. And they on their side, they're hedging their exposure, so they're not taking a bet, right? The counterparty isn't taking a bet. All they want to do is be market neutral, and they're collecting a fee off of the balance that we may have with them to get that notional exposure. So as by the way,
not sure, but that fee is a lot less than the margin rate, right? That's what somebody would get, right? I mean,
yeah, right. Our net expense ratio right now is 130 basis points, right? So that's there's a fee cap on the fund. So if you're, again, using leverage in your brokerage account and paying less than 130 basis points, good on you. But I suspect it's probably not that. And listen, Paul could probably talk to, where he trades. I don't know if they're allowed to use leverage. And that, again, that's another thing. A lot of fiduciaries just aren't allowed to use leverage. You can use leverage funds for your clients, but you can't actually use, leverage and borrow from the custodian, right? Like Fidelity, a Schwab, E-Trade, whatever it may be. So that's why leverage products, even amongst fiduciaries over the past 18 years, or ETFs anyway, they've been so popular because it just really solves the problem of having to do it on your own.
And you also can't use margin in a retirement account. So in a qualified account. So even if there's a magic wand and I could put together, a leveraged account for under 130 basis points or 1.3%, you can only do it in taxable accounts. So it gives you a challenge in running your models if you wanted to put leverage on in an IRA or a Roth or a 401k.
I'm curious, Paul. I mean, we're towards the end of the year here in 2024. Obviously, a lot of talk about, a Trump trade is very bullish on equities, deregulation's bullish, and Trump is going to be very bearish for treasuries because of how much debt there's going to be, unless the Department of Government Efficiency, DOGE, is able to counter that. If you were to bet on a single levered asset class, would you bet on, let's say for 6 months, right? Would you bet on the S&P or would you bet on treasuries?
You asked me the question about basically what's the best return and what's the best time frame. Good on you. You're gonna put me in a corner and pigeonhole me. All right.
Of course, man.
I'm taking next 6 months gets us through to April. I'm taking NASDAQ 100. I think it's been consolidating. And the whole Trump trade thing, as I try to explain, the single biggest question I had all year long was, how is the election going to impact my portfolio? And I said this for my whole career. Elections have zero impact on markets and economies until at least Halloween of election year. So I kept dismissing that. And I've got data 100 years. Nobody can prove to me that elections have any impact until you get to at least Halloween. And then after that, this is not, my view is this is not 2016, and 2017 will not be repeated in 2025. We've been long and strong since the end of 2022. It's not a Trump or a Harris thing. It's the regime. Mike, you talked about early on with the cycle where you are. You're 2 years into a pretty good run. But next 6 months, I think the NASDAQ 100, which has been consolidating, holding on, is going to get some love again. because I do think the rally narrows in 2025. My bearish friends are becoming a little more bullish, and I'm becoming a little more cautious. I think next year on balance, right now we're up mid to upper single digits. It's really hard. 95, 6, and 7 were three really unusual years. 95 was the best year of the modern investing generation. By the time we got to 97, post-election year, you had two 10% declines in April, and then you had that mini crash in October. And the year still ended up, but it was a lot more volatility. And I think that's a model for 2025. But I'm still sticking with the levered Qs over treasuries next 6 months.
As correctly noted on X by somebody watching, not financial advice, obviously, folks. Just more of an interesting sort of way to think about what happens going forward. Obviously, as an issuer, Matt, you don't really care which product is doing well. You just want one of them to do well to get hopefully some attention on assets. Granted, it's still early for trader ETFs in terms of its product suite, but in the conversations you have with advisors, with some high net worth individuals who are thinking about using your funds, is there an overwhelming sort of sense of this is the type of calendar reset I want to focus on, or type of index I want to focus on?
It's still such a new. Remember, we only launched these products in September, right? Yep. So we're 2.5 months out. So I think folks are still getting their head around which is the best one to use and when. If you're a more active trader or swing trader, for instance, maybe the weeklies, right, are a better setup for you. If you I really like sort of Paul's thoughts about retirement account. If you just kind of want to get that amplified exposure, maybe the quarterlies are better. If it's going to be a set it and forget it for the next 5, 15 years, you're okay taking a little risk in terms of owning leverage in your account there. Overall, though, I feel like the monthlies, Mike, have sort of gotten the most traction in terms of conversation, because it's a good balance of not too actively systematically resetting that leverage, right, and not just kind of waiting out the quarter to see what happens. I mean, we'll see how, what that path is, right? This year, it's just pretty much outside of a little blip in the summer, kind of just been up, and up. And I don't know. I always find it interesting. It's like next year, and Paul, maybe you could talk about this, but like when the calendar turns in December, what really changes? Yeah, we have earnings, but like why all of a sudden, that's why I've always found it difficult to kind of like look at annual returns versus a maybe more of a moving average. And Paul, if this is hits home to your strategy, I think people would really like to hear more about it. But like all of a sudden January 1st comes and it's like the clock gets reset. It's like life doesn't really work that way, right? I mean, just we the cycle doesn't work that way. Nothing changes. It's not like all of a sudden we take a fresh look at what the rate picture is going to be, or where's gold right now, or oil, the oil demand changes on January 1st. It doesn't. So I always scratch my head a little bit, even though I've just been doing this a little while. Like, why do we just reset expectations and numbers? Is it just because it's convenient, because it's a calendar? Maybe. So Paul, I would love to hear your outlook on, and especially as you're managing money for clients. Like,
right.
Okay, going into next year, like, do clients really care about next year? I mean, they probably just care about, hey, Paul, I've had money with you for 10 years. Like, here's what I've done. Talk about it.
So usually when you ask these kinds of questions and you look for an answer, it's pretty simple, and it's money. So like my clients, we do our quarterly reviews. We talk about different rates of return over different time periods. But in the end, what do my clients want to know? They want to know, A, do I have enough money to retire? B, am I going to run out of money in retirement? And C, they want to make sure that their account's going from lower left to upper right. That's the three things that clients ask about. To your question and comments about why does the calendar magically turn? So think about money. Think about how many portfolio managers are compensated. What's happening in the fourth quarter right now? The great performance chase. Just like what happened last year. It was a really good year. People came into 2023 and 4 very negative. So they almost immediately got behind the 8 ball. And then both years, each quarter that went by, there was always a reason to be a little negative. Now, this year it was the election and recession, and then last year was inflation. So you get to Q4 and people are like, holy geez, I got 3 months left. I'm trailing whatever benchmark I have by X percent. I got to chase now. So now they got to chase, and they typically don't chase and buy defensive stuff like utilities and staples. They're going to buy Momo and high beta and sexy and fun stuff. And that's why you see, when you see tax loss selling, if I owned a pension fund, a mutual fund, whatever I report, a hedge fund, I don't want to report all these securities that, I don't want to report that I own Moderna and Albemarle. And I mean, the list goes on and on. CVS, which we do own, by the way, but you don't want to show that. So the people tax loss sell, they buy winners. And then when the calendar turns and they get a whole new lease of life, they wipe the slate clean, their compensation starts over, and they go back to buying some of the downtrodden stocks again. But it's simply because of money.
Fascinating.
Yeah, and I mean, in general, there's, it's like New Year starts and people have resolutions, and suddenly the mentality changes. And aside from the money aspect, it's just something psychologically about the turn of the year causes usually a change in behavior, which I would argue is actually a good thing. And I want to get your thoughts on this, both Paul and Matt, because the last 13 years, right, leverage or no leverage, it's been a game of just the S&P and NASDAQ, right? And I'd argue it's been very hard to tactically beat the S&P unless you levered the S&P the right way.
Yeah.
Which is, by the way, so I always go back to, at a very kind of core basic level, there's only two ways to beat, in quotes, the market. You either tilt smaller, mid caps, small caps, or you tilt international. The third way is to leverage, right? But there's nuances to that too. I wonder if you think, aside from the turn of the year, if there's a turn of the cycle where maybe it is going to be easier to, in quotes, beat the S&P 500 more broadly.
I'll let Paul go first.
I was going to say, let Matt go first. All right, I will. So there are some inherent challenges to beating the S&P 500, right? Because the S&P 500 is cap weighted, and you've got 7 stocks that have this enormous weighting, and that's just how it is. It's not. People say, "Well, is that bad or good?" It's neither bad nor good. That's just how it is. So if you're happy with 8.5% a year over the next 100 years, then you should just buy the S&P and set it and forget it. I don't think most clients, that sounds great in theory. I don't think most clients are happy with the volatility and the potential losses, which is why they seek, kind of other forums. Michael, I do think that, I don't know, I never use the phrase new paradigm because that's always some kind of bell ringing. I do think that you've at worst, you have a mean reversion play where equal weighted S&P can outperform the S&P, especially in the next 6 months. Clearly, the Russell's gotten some love, one, because of what's been going on politically, and maybe it's tied to it, but the dollar's been really strong, and the Russell companies are typically more U.S.-centric, and the big S&P companies have a more international flair. So that's right. That trend probably, it's not a day-to-day thing where you have to go, oh, today the Russell's down, 96 bips, but yesterday it was up 105 bips. It should be some kind of regime play that you can work on for more than weeks, months, and quarters. And to your point, I agree that if you're looking to outperform, you can go smaller into the mids and smalls. You can go into international, emerging markets or developed markets. You can add leverage. You better just make sure you have a plan when things don't go your way. And for those who are really skilled and have tremendous trading acumen, you can add exposure and reduce exposure opportunistically.
Yeah, maybe I'm just. You sort of think about. It's just really hard to beat the benchmarks. So you might as well just be the benchmark, right? I mean, think about how everyone invests in their retirement account, their pension, 401ks. It just goes into plain vanilla funds. So more money keeps chasing these broad benchmarks, right? And it just ends up being this momentum issue, that I always think about, and not a momentum as a factor investing, not like a, quality size, but this money, more money begets more money. The bigger it gets bigger. And over time, I think it's just going to be harder and harder to beat a benchmark. And now that I think about it, I'm saying, well, why is January just all of a sudden the clock gets reset? And it's like, just because it's easy. It's just easy to invest in a broad benchmark. You don't have to think about it. Most folks don't want to think that their job isn't what we do, right, Paul? They're not in finance. You have other lives, and you use money as a means to an end, or before the end, so it's not something that you really want to think about, and nor do you have any interest in thinking about. So for the casual trader or investor, a benchmark, whether you want to call it smart money, dumb money, wherever it may be, it's just easy, and you can mostly understand it, versus thinking about, complex strategies, or, investing in some thematic ETF, or some, active ETF based on, really long-term trend. And it's just, again, time. As much as I'm not a boglehead, it's worked. Right. And, trying to select stocks is, I think, just becoming increasingly tougher, in this environment, as just money continues to expand. Right. And it's never going to be something that the average investor is going to be able to spend enough time doing, which is why you have professionals like Paul, who is fiduciaries, who are, depending on your goals, let's think about how you really want to allocate your portfolio. So for me, Mike, I just think that you're almost longer term, from a safety standpoint, a volatility standpoint, just the major benchmarks are just always going to be there, and just kind of probably provide a level of comfort that, strategies that you're not going to be able to actively employ by yourself, that they're going to be able to provide.
And one thing, don't forget a couple things. One is that the S&P 500 and the NASDAQ 100 are not static, indices. There's active management involved, because NASDAQ and S&P are adding and removing companies on a regular basis. So that's one. And two, getting back to Michael, you asked your question and comment about the Russell. It's my sense that for 10, 15 years, the Russell has been used as a hedging index for big money. So it's made up of a lot of companies that don't make money, where the S&P 600 makes index are companies that make money. But I feel like a lot of institutions use the Russell as a hedging vehicle. That's their preferred index to short against longs. Similar to that, that yen carry trade that's been going on supposedly for 30 years. When it reverses sharply, and then people who came on last are going to get punished the most. But I think if there is a regime change, and it's more than just a week or two or four, you're going to see some upside in the Russell versus the S&P, because you've got so many institutions that are shorted against the basket.
Yeah, I think it's exactly right. Paul, as we wrap up here, I want to give you a chance to talk about your practice for those that are listening that might be interested in some of your services. Talk about how they can find you.
Well, you can find us on it's investfortomorrow.com. Shameless plug there. And so I write a blog 3 days a week, and then we do more longer term writings after that. But look, we cater to mid and high net worth individuals. We run 21 active strategies. We have fixed income, we have metals, we've got a combination, and we've got certainly an awful lot in the U.S. equity market, levered and unlevered. So, people come to me, again, I said it before, they want to know, do I have enough money to retire? How much do I need? Will I run out of money? And will my account go from lower left to upper right? Those are the goals that clients have. You mentioned it earlier. Our goal is not to buy the bottom and sell the peak. It would be nice and sometimes lucky when you do, but that's not our goal. And we do set benchmarks. I can't say that every client tells me your job is to beat that S&P 500. Typical clients are pre-retirees, and retirees don't think like that. They want to make sure they're taking care of the rest of their lives. They don't care if it's S&P 500, S&P 100, or the Wilshire 5000. It's not really in their wheelhouse. That's not why you hire, a fiduciary financial advisor. So that's how we run our practice. I've done it for decades. Hopefully I've got another 20, 25 years left in it. But I enjoyed it. I have a trading background, but I enjoy managing money. I love working on our models, but I really love meeting with clients. That's my favorite thing about my job. I get to do that every day.
And Matt, for those that are listening that want to get more information on trader ETFs and learn more about the calendar resets and different funds, talk about that.
Yeah, so you can go to our website, Trader ETFs, TRADR ETFs, plural.com. And you have any questions, we do have a contact form there. Feel free to send in some questions and we can get back to you. It is a new concept, these concept of longer leverage, and it's called, I like to call it systematic leverage. So if you do need some help in understanding it a little better, please reach out via the website. And we are on Twitter at traderetfs.com, and also a place to kind of see what we got going on there.
Everybody, please make sure you check out Paul's firm as well as the Trader ETFs. My name is Michael Guy, and again, this is Lead Lag Live. Appreciate those that watch this live, and I'll see you all on the next episode. Thank you, Paul. Thank you, Matt.
Thanks Mike. Appreciate it.
Thanks, Matt.